Hello and welcome to Portfolio Matters week 74. And again, a very busy week in the markets, particularly in bond markets. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Right, first of all, news. Well, the blonde buffoon survived, sadly, and remains PM.
Can I just point out we are apolitical here?
We are apolitical. That was an apolitical statement, Richard. The OECD cut their forecast of UK GDP growth to 0 next year. So they're very pessimistic for the UK economy, and they think that the UK will suffer from very high inflation and slowing growth. Now, the big news of the week was that the ECB confirmed that it will start to raise rates in July. So it's going to raise rates by 25 basis points in July and warned the market to expect a 50 basis point rise in September. And it will end its bond purchase program on July the 1st. So that has caused a sell-off in Italian and Greek bonds, and we will go into that in some depth. So this week, the rates section is really quite important, and I urge you to hang on and listen to that, which is one of the last pieces we do in the weekly. It also upgraded its forecast for 2022 Eurozone inflation to 6.8%, up from 5.1%. And the World Bank slashed its 2022 GDP growth forecast to 2.9%. Last year, growth was 5.7%. So the World Bank are forecasting much slower growth this year, and that is a worrying trend of cutting growth forecasts. Okay, so moving on to economic data. In the UK, the Halifax House Price Index continued to beat expectations. In May, growth came in at 10.5% year on year, which is astonishing resilience in the UK housing market, given the slowing economy and higher mortgage rates. But the construction PMIs missed expectations. In April, it was 58.2. The market was expecting a small drop to 57.6. Instead, it dropped to 56.4. So the construction activity is still expanding, but at a slower pace. Now, in the US, the big news was payrolls, and I'm not going to go into that now because we have a special section on it, but it was strong. Manufacturing payrolls missed expectations. Now, a while ago, I did a special podcast on how the housing cycle is the business cycle. And in that podcast, I talked about the only two sectors of the economy which tend to lose jobs during recessions. And that's the housing sector and the manufacturing sector. So going forwards, we need to be watching employment in those two sectors as a harbinger of possible recessions. And if you look at manufacturing payrolls, big miss. So in April, the manufacturing sector in the US created 61,000 jobs. In May, only 18,000, well below expectations. So something to watch. Now, we also had non-manufacturing PMIs, and those beat expectations, but were down on April. Manufacturing activity dropped sharply, missing expectations. The prices paid index dropped, which is good news. And new orders actually rose. Now, I'm not sure how you reconcile the PMI falling on the month while new orders rose. There you go. And a couple of charts. So the market now expects that ECB base rates will be 0.9% by year end. So that was a big jump on the week after Christine Lagarde's speech. And these are Italian bond yields, which rose sharply, and that is worrying, and we'll go into that in some depth later. Some charts, Richard.
Thank you, Keith. So EU retail sales month on month have fallen back, and UK retail sales are also falling back. UK Halifax House Price Index year-on-year change showing remarkable strength. One wonders at what point that might come off. And the UK construction PMI also looking healthy at the moment. The US unemployment rate low and staying low. US non-farm payrolls is low.
Well, it's reassuring. That's a decent number, actually. We've got a special section on non-farm payrolls coming up.
And the US average earnings growth year on year seems to be stabilizing at around about 5.5% at present. And US employment participation rate is continuing to rise steadily. US manufacturing payrolls have dropped sharply. And US non-manufacturing PMI is continuing to fall from a high level. And US non-manufacturing business activity looks like it is falling away a bit. US non-manufacturing prices paid, not really showing any signs of reducing, significantly up. And US non-manufacturing new orders, tricky to interpret other than saying it's very similar to what it's been for the last 8 or 9 years, excepting COVID. US total vehicle sales, clearly not very healthy.
Yes, well down on pre-COVID levels.
Yeah. And US initial jobless claims is starting to rise again. Continuing jobless claims, however, is fairly stable at quite a low level. US 30-year mortgage rate was sort of had a temporary peak at 5.5%. One presumes it's going to go up from there as the Fed continues to raise interest rates. And the US MBA purchase index, which includes all mortgage applications for the purchase of a single family home, is really, really low. As Keith says, if the housing market is a harbinger of a recession, then this is not looking healthy for the US economy. China services PMI is picking up, which is actually what you'd expect given they're starting to unlock after their very tight COVID lockdowns.
But it's at low level. I mean, 40 is not a good number.
No. And their composite PMI exactly the same. So we see the Chinese economy is beginning to recover after the lockdowns. The US growth appears to be slowing, but it's not in recession yet if you look at the PMIs. The collapse in impending home sales is not a good sign for the US economy, given where the construction sector sits in the degree of importance it holds in the health of the US economy.
Right, thank you, Richard. Okay, one chart this week is US gasoline supply. So the yellow line is the average gasoline supplied throughout the year in the pre-COVID years between 2017 and 2019. The red line is 2022. essentially, after the sanctions on Russia, the US lacks refining capacity. And despite record prices at the pump, it can't supply as much gasoline as it used to do. And I have checked these numbers on the EIA website, and they are correct. So in summary, there's no easy solution to the gasoline shortage. And prices will have to rise until you get demand destruction. There is no solution.
And as an investment recommendation on the basis of that, it's refiners.
Yes, refiners, actually, the majors will do very well. I mean, the trouble is, Richard, it's a very good question, because oil prices, gasoline prices will rise until they destroy the economy. So where do you invest? Because actually, oil equities could well not follow the oil price up. Difficult.
Very difficult.
Okay, on to inflation watch. Richard?
Thank you, Keith. So we have no new data this week. I think we're expecting US data imminently, aren't we?
Yes, today. We'll cover the US inflation numbers next week.
So the UK is forecast to be the highest in the G7 over the coming 3 years, UK inflation. I don't actually know why that is particularly. Do you, Keith?
Declining exchange rate, structural inflation. We have a history of high inflation. And if you look at the Bank of England, we have very high inflation. The Fed is being very firm about its intentions to raise interest rates to fight inflation. The Bank of England, less so. It's not making the right noises.
No, but neither is the ECB, is it? But the European inflation is not projected to be as high as UK inflation. I'm just curious as to what factors it is make them think that the UK is going to have the highest of the G7. It's not good, whatever they are. So US apartment rental rates continue to rise, as I think we said they would, and we have been saying they would for months and months. And 15% year on year is really, really very high and must be damaging disposable incomes. And census data shows strong wage growth in the US, 6%. We were looking at a graph earlier which showed it to be about 5.5%, 6%. So it's nudging at the highs, basically, of the last 40 odd years.
Yeah, and that is a wage price spiral. That should have the Fed worried, because essentially what that is showing is that workers don't believe the Fed's 2% target and are seeing very high inflation and are demanding wage rises.
And note how quickly it's got there. If you look at the others, they don't spike in the way that this has spiked up. And US wage growth is occurring across all sectors of the economy. And these are really quite frightening increases in hourly earnings.
Yeah. Over the last 3 years, earnings in leisure and hospitality are up the best part of 25%. That is inflationary.
So this is a model-based global CPI inflation projection. And as you know, we are quite cynical about these projections. And what's quite curious about this chart, Keith, is that obviously we are here at 2022 Q2, and we have a nice little peak. And then surprisingly, we have a line going off at about 90 degrees heading downwards. So the OECD is still using its original protractor forecasting model.
Yeah, I think they all share the same model, actually, Richard. They all kind of solve for inflation at 2% in a couple of years' time.
They have their schoolboy or schoolgirl geometry kit, and that is as far as they've got. And it is pathetic, actually.
This chart shows US excess household savings from the beginning of the pandemic. And it shows that US households now have $2.3 trillion of savings more than they did prior to the pandemic. If you want an explanation for inflation, here you are. The Fed got it terribly wrong. They just printed far too much money, basically. And now they're going to have to continue raising rates till they get inflation back under control. And if you look at savings broken down by income threshold, then all sectors have higher savings than they did prior to the pandemic. So all that excess savings, you could say, well, if it's all with the wealthy, then it won't be inflationary, but it's not. It is spread out throughout the economy. All sectors, all income brackets have better savings.
And this is a wage prices spiral, as we talked about for some time. I think back in the autumn was whether the inflation impulse would result in a wage price spiral. And lo and behold, it is. And I think one of the arguments against there being a wage price spiral was the relative lack of unionization. But what we're seeing in this country is significant union activity and significant anger amongst particularly the lower paid people who are seeing their disposable income annihilated by the inflation that we have. And this is undoubtedly going to lead to, in my view, we are in a wage price spiral now, and it's going to get significantly worse before it gets better.
So in summary, what we've learned about inflation this week is that US wage growth may be moderating, and there are indications that inflation in the US may be peaking. But US consumers have savings and continue to spend, and the Fed is going to have to raise rates quickly to high levels to counteract strong underlying demand. All that savings, consumers can spend it, and that means they can continue to support demand. In the UK and Europe, inflation continues to rise, and monetary policy is still very accommodative.
And I would just add, it's very difficult to see how it can be made less accommodative without causing severe damage to the bond markets.
Well, we've got a section on Italy coming up later, Richard. Okay, on to Recession Watch. And I thought this was a nice chart from Fidelity, and they have put the various economies of the world on this on a cycle chart, and they're showing that they think the Western economies have now passed peak and are heading towards late cycle and then recession. In contrast, they have China coming out of contraction. Not sure about that. China's come out of a self-imposed brief recession.
I think, yeah. So this is showing that Andreas Steno Larsen is forecasting US ISM manufacturing PMI will fall below 40 early next year. The point about this is when US manufacturing PMI falls so low, you have a severe recession. So there are people out there who are forecasting that the US is going to go into a severe recession.
Yes, absolutely. And that's his forecasts are based on a model derived from the bond market. This is US consumer sentiment towards buying a car, and it's absolutely collapsed. So that portends a collapse in durable good expenditure. And as we discussed earlier, the manufacturing sector is highly cyclical. And if the manufacturing sector starts to turn down, that is a contributor to a recession.
Just thinking back to that cyclical chart from Fidelity about where people were where countries are on the economic cycle. If US, Brazil, Mexico, a large chunk of the world is either in a negative growth or approaching it, it's very difficult to understand how China could not remain in a recession.
We talked about China before, Richard. I think they've got huge problems, particularly the property market they've tried to support it many times, but the reality is that its prices are now so elevated that you wonder how long they can keep on propping up these incredibly overpriced apartments.
It's too big.
Yeah. And suddenly, companies are talking about hiring freezes. So you may have heard in the news, Tesla R1 imposing a hiring freeze, and that is a contradictory indicator. It suggests that actually the employment market may be peaking. And the Citigroup Economic Surprise Index for the US continues to be negative. And another thing that happened this week was that the big US retailers warned that they were carrying a lot of excess inventory. And we've talked previously about the inventory cycle and the beer supply chain game. And when retailers hold too much inventory, they cut back on their orders with manufacturers. And that then exacerbates a slowdown in the manufacturing sector. We covered this chart last week, and we were saying how the Atlanta Fed's GDP Now forecast had remained remarkably stable over the course of May, and then it didn't. Then it promptly fell to now around 0.9%. So they're forecasting that Q2 GDP growth in the US will be 0.9%. So in conclusion, there are forecasts that GDP growth is going to slow, but currently both the US and the European economies are doing okay. And actually, particularly the European economy has been surprisingly resilient, and there are few signs of an imminent recession, although lots of warning signs for later in the year. Okay, so now we have a special section on whether the Fed can engineer a soft landing. Now, it is raising rates and aiming to get inflation under control without provoking a recession in a soft landing. Now, if you look at the history of Fed hiking cycles, you'll see it has managed to do this in the past. So the black line is the Fed's fund rate, and the peaks, which are starred in green, are ones where the Fed hiking cycle peaked, but there was not a recession. The yellow ones are where there was a softish landing. The red ones, when there was a recession. So history suggests that a soft landing is possible. I should say that all these charts are from John Authors at Bloomberg. But the only times that you've had a soft landing are when inflation has been at low levels. So if you look at the green dots, inflation has always been at 4% or less. The red dots all occur when inflation is very high and the Fed has to raise rates quickly to get inflation under control. And where we are now is inflation in the US is at 8%. And so frankly, that's not reassuring. The Fed is going to have to raise rates hard, and the likelihood is from history that a soft landing will be difficult to achieve. And if we look at the history of financial markets, tightening financial conditions generally reveal who's been swimming naked as Warren Buffett would say.
Mm.
And generally, you provoke a financial crisis. Pause the video, take a look if you're interested. So our conclusion is that a soft landing is possible, but unlikely. The Fed is behind the curve. Interest rates in the US are between 0.75% and 1%, whereas inflation is at 8%. In order to get ahead of the curve, to get inflation under control, is going to have to raise rates quickly. And that is generally bad for the financial industry, particularly when they have extended a lot of loans. And we know that general indebtedness is at an all-time high. Moving on to QT, and this is a really important section. So the Fed balance sheet has grown enormously since the great financial crisis. Pre-GFC, it was stable at around 1 trillion. It is now at 9 trillion. And you'll see during the pandemic, it absolutely shot up and has more than doubled in just over 2 years. But it appears to now have peaked, and the Fed has said from June, i.e. this month, it will stop reinvesting the cash as bonds expire. So we're going to go into QT. Now, QT works by essentially the Fed, it has bought all these bonds from the government, and as they mature, the US Treasury has to repay the Fed the face value of the bonds that the Fed has bought. The Fed then takes that cash and cancels it. The US government then needs to refinance itself and replace the money it's given to the Fed. And it does that by issuing new bonds that it sells in the market. And those bonds are sold to the private sector, who have to sell other stuff or withdraw cash from the banking system to buy those bonds. So QT takes liquidity out of the financial system and shrinks the money supply. But remember that money creation in a modern economy is mainly a function of the banking system. And if banks loan enough money, they can offset the shrinkage caused by QT. And currently, US banks are lending money. But if the economy slows down, that will also slow. And therefore, you'd expect QT to reduce the money supply. And so far, credit creation in the banking system has not been enough to offset the drain on the private sector from taxes and the reverse repo facility. Essentially, the reverse repo facility means that commercial banks would rather lend to the government than lend out to the private sector. When you lend to the private sector, then you create then there's money creation. When you lend to the Fed, there's not. Now, when QT reaches full speed in September, the Fed's balance sheet will be shrinking at a rate of 1.1 trillion a year, removing 1.1 trillion a year from the financial system. And there's an article in the FT this morning talking about how the Fed estimates that is equivalent to a further 56 basis points in rate rises. So it's going to tighten financial conditions. And that is bad for financial assets. So QT is important, and we'll just have to watch what happens going forward. As we discussed last week, I think there's no way on earth that the Fed is going to be able to fully execute its plans on QT and reduce the balance sheet, because financial conditions will tighten quickly and induce a recession, at which point the Fed is going to have to loosen financial conditions again. Richard, your thoughts?
Yeah, as we've discussed many times in the past, Keith, the Fed, the ECB, the Bank of England, they're all in effectively the same bind with maybe different varieties, which is that there's too much indebtedness. We've got a high rate of inflation. The classic cure for inflation is to raise interest rates. It can't be done, and the way out, I think, is not very clear, because the policy decisions that the central banks and politicians make are in fact hard to predict. But I think what we can be clear of is the way out will be messy. And in terms of managing your portfolio, your investments, you need to have them in places where, when this does get messy, your assets are going to be relatively safe.
Yeah, expect volatility, actually. The one thing I think we can predict is volatility.
Yeah, definitely.
So in order to navigate that, I think you need to be nimble.
Yes.
Now, finally on QT, I thought this was a very interesting chart. And the chart of the fangs are laid with the path with central bank assets. And if the Fed now starts to shrink the balance sheet and this relationship holds, then bad for the tech sector.
The most efficient route out of this is to have several years of rampant inflation, actually, because that effectively rebases the fiat currency and removes the huge debt overhang. So all other things being equal, what policymakers would like, I suspect, is 2 or 3 years of 20 to 30% inflation.
Well, the trouble is, Richard, you can't get there in a straight line, because if we have elevated inflation and bond market investors come to believe that the central banks of the world are not going to enforce their 2% inflation target, then bond yields go to 30% or whatever the inflation rate is, and that bankrupts all the governments of the world.
Yeah. So before the debt is deflated by inflation, the governments go bankrupt, and then the deflated debt becomes an irrelevance.
Exactly. And when government bond yields go to 30%, and so their price goes down by huge amounts, 70%, then everyone's pension fund disappears in a puff of smoke. You get very unhappy people. So I can't see that. In theory, you want to inflate away the debt. In practice, I think that's actually more difficult to achieve.
Yeah, without a complete breakdown.
Yeah.
So moving on to the US jobs report. So the jobs market is actually in the US is still looking very strong, and the belies people who are calling for there to be, or who are projecting there's going to be a recession, certainly at the moment. And we've got very low unemployment, and as we've discussed earlier, we have this increase in average hourly pay. We have seen sort of different data coming from different sources on the average hourly pay, but they are consistently moving upwards. So we've got strong employment, basically strong pay growth, and the only area where there is a shedding of jobs at the moment is in the retail trade. But of course, the retail trade is highly sensitive to recession. So is that a harbinger of recession?
I'd also highlight the growth in construction sector jobs, which is quite surprising and shows a US economy which is resilient.
So a change in non-farm payrolls is very stable, isn't it? It's 500,000 jobs a month, roughly speaking, net gain over the last year and a half. No sign there of a problem in the US jobs market. And as Keith just said, the construction sector is continuing to add jobs. Strong construction sector is equated to a healthy economy. We have seen, of course, data which suggests that the construction sector is in fact slowing down, and the timing of all these moving parts is quite hard to predict.
Yeah, of course, if projects have already been started, they need to be finished. And so there's going to be a big lag.
Exactly so, yeah. You see that in London, actually. There's a lot of office complexes which are going up at the moment. And I think the logic there is not that the developer actually wants to have an empty office block on their hands, but that an empty office block is worth more than a half-built office block. But this is showing how economies have regained how the US economy has regained employment after various recessions. And the US economy hasn't fully regained all the jobs lost in the COVID recession. It's not far off. And of course, we know that the employment participation rate has dropped substantially since then. So the participation rate, which is the thick red line, and you can see the COVID drop in the participation rate and the fact that only an element of that drop has been regained. So that pushes the employment rate up artificially, if you like, statistically. And you can see that the employment population ratio is actually hasn't regained the pre-COVID figure by any means. And the unemployment rate is actually extraordinarily low. It's as low as it has been since 1968, I think, eyeballing this chart. And that, again, that is not a recessionary indicator. But all of these employees are being hit by the high inflation rate and the loss of disposable income, particularly at the lower end of the earnings level. So I think we have some conflicting data coming out of the US. Actually, I think there are signs of economic problems. So we have the auto sales, or the confidence in buying a new car is very, very low. Retail employment is dropping, but other economic statistics are really quite strong. So another strong US jobs report and high levels of employment in the construction sector. So we have some conflicting data, but on balance, I think the data suggests the US is not in recession. But we also know that we have high costs continuing to come through. The oil price is not falling back. And so there are some very significant cost pressures coming into the US economy, as well as the rising interest rates.
Thank you, Richard. But there's another survey of US jobs, the ADP jobs report for May, which came out, and that paints a slightly different picture. So it showed a gain of only 128,000 jobs in May, the lowest since COVID. If you look at their numbers, frankly, there is a clear downward drift over the last 6 months. And we talk about construction, they're saying there was a fall in the employment in the construction sector. And that is interesting and maybe the first sign of a slowdown in the US. And so when you're talking about contradictory data, well, even in the jobs reports, there's contradictory data.
Yeah. So we're going to do a little bit of a deep dive into food now. We're all aware that there is a looming world food crisis. So this graph showing the fertilizer prices versus the crop index. And we can see that the crop index has risen by about 50% in the last year. Fertilizer prices have risen by about 250% over the same period. And what that means is that farmers are facing hugely increased costs for fertilizer in order to bring this year's crop to fruition. And diesel prices, the US diesel prices are record levels. I think they're probably at a record level in Europe too. Diesel is a big input into modern farming. It's very efficient, uses big tractors, very few people working on the land. And so it is a big cost of food production and of food distribution. And we see that that has probably doubled. Natural gas. So natural gas is a big input into fertilizer manufacturing. It's made nitrogen-based fertilizers made using natural gas. And natural gas prices risen very considerably. So that's one of the reasons fertilizer prices have increased so much. And we see the same in European natural gas prices and US natural gas prices. And we know also that some fertilizer plants did shut down because the cost of producing fertilizer was uneconomic. Haven't heard that they have remained shut, so I assume they've restarted and they're producing fertilizer at much higher costs to them and therefore selling it at much higher prices. So the other thing about natural gas, which is not obvious perhaps, is that I'm going to skip down to the penultimate bullet point. So in Holland, greenhouse season started late after natural gas prices peaked because they didn't want to heat their greenhouses with expensive gas, and they thought they'd wait for the price of gas to drop. But also by the burning of the gas is used to produce electricity, which is one of these unexpected consequence things. So by not heating their greenhouses, they weren't producing electricity. So there was a shortage of electricity, which led the government to order farmers to keep their greenhouse heating on. And of course, that is a huge cost to them. They have to put their costs in now, but they don't get their proceeds from their selling their goods until much later. And just skipping back up from the top, in the UK, production of cucumbers and sweet peppers in greenhouses is expected to be 50% down on 2021. What that will do to prices is self-evident. And we see here farmers' profits being squeezed, but also a big squeeze on prices that we probably have not experienced yet.
Absolutely.
So then these are some charts of various agricultural commodities. Note that 2022 is halfway. So the bulk of this price rise has occurred in the last 5 months. And very big price rises in soybeans and in wheat. As we've heard in the news, there's a lot of Ukrainian wheat, which is basically stuck in the Ukraine. And we now hear that Putin is using it as a bargaining chip to have sanctions lifted, AKA he's saying half the world can starve or you can lift my sanctions. This is a graph of cheese price, which has actually gone up by 50% in the last 8 months and will be experienced in everybody's supermarket bill. And then we've got palm oil, which in the last 12 months has gone up by about 80%. All of these are pretty basic foodstuffs. Orange juice has gone up by 50%. Rice has gone up by 30%. These are all very big increases. Rapeseed oil has gone up by about 30% since last July. Sugar actually it's been quite stable, one of the few that hasn't really changed very much. And corn, which has gone up very significantly over the last year, well, certainly over the last 8 months. And I think the issue here is that the percentages are really quite substantial in terms of what particularly third world countries, third world consumers can afford to buy. Yeah, so the food price index in different currencies is shown here. I think there are two things. One is that there's a big cluster of them around about 60 to 80%, up to 100%, which is a huge increase in the last 2 years. And then we have Turkey, where food prices have gone up 3.5 times in the last 2 years. And I noticed that Erdogan is now starting to panic about the Turkish rate of inflation, because clearly it's going to lead to civil unrest in Turkey. So we have seen a bit of a leveling off in agricultural commodity prices over the last 3 months, as we saw in those charts. There's a great deal of uncertainty about what the output will be at the end of the Western summer, i.e. around about September, October time. And we do know that costs have gone up very substantially. So you would expect prices of this year's harvest to reflect those substantial increases. And you would also expect the quantity of food produced to have reduced as farmers are unable financially to use such high levels of fertilizer and pesticide as they would have done so previously. So although it's gone slightly quiet, I think, on food price I suspect that we are not out of the woods yet by any means.
Okay, on to other charts. So this chart from John Authors at Bloomberg shows the best return of the various major asset classes. And you see that only rarely do all major asset classes turn down. But that is what happened in Q1 2022. So the best return you could have got for all the major asset classes is from world equities, which only lost 4.5%. The 30-year Treasury lost the best part of 11%. So it's been a tough quarter for investors. And just to reiterate that point, it's very rare that both bonds and equities do badly at the same time. So the x-axis is the return of global bonds, and it's lost more than 10% so far this year. And the y-axis is global equities, and they've lost more than 10% as well. So the 60-40 equity bond portfolio has had a bad start to the year. Now, I thought this was a really interesting chart. This is private debt to GDP, and the yellow line is China. And private debt there has grown very fast to very high levels. And whenever that has happened in the past, that generally portends bad things, such as the great financial crisis. So, or the dot-com bubble. So has China reached the end of its debt-fueled growth spurt? What comes next? Something to worry about. But finally, this weekly is packed full of doom and gloom. So here's something to cheer everyone up. This is European wildlife populations. And I didn't realize this, but since 1960, there's been an absolutely huge resurgence in the populations of the major European mammals. It's great. So, conservation does work.
It does. Very good.
You don't sound that cheered, Richard.
No, I think it is very good, Keith. I'm interested in the southern chamois, which presumably means that it's going to be possible to get a chamois leather for one's car.
Yes. Right, you mean we should start shooting them again?
I think Katie's just come back.
I think you're taking the wrong message from this chart, Richard.
So moving on to our equity markets weekly checklist. Generally speaking, negative week for the equity markets. FTSE All Share down 1.6. Stocks Europe down 2.7. The S&P down 3.8, and the Nasdaq down 4.6, going from best to worst. Hang Seng up 3.7, and the Topix up 0.5. Bitcoin just down 1.2%, a very small move for Bitcoin. And the pound against the US dollar is down 0.7%, down 7.5% for the year. And anyone buying foreign currencies to go on holiday will know the pound has fared pretty poorly over the last few months. And the dollar index bouncing around between 100 and 104, really. So the S&P 500, yes, the bear market rally is probably over. The Nasdaq, and if you guys just cast your mind back to the graph we had earlier showing the Fed balance sheet versus the Nasdaq, actually, versus the FANGs. Once they start QT, this graph has only one way to go.
And I'm reminded, Richard, of the cartoon we had in last week, so weekly, of is this a bear market bounce? And we said, yes, it is. And we were right.
Yeah. Very true, Keith. And there we have that you could just cast your mind out and just cast the Fed balance sheet on top of that graph. And if they do QT, I think the jury is out on how much they'll actually do. And that chart is going to follow.
Yeah, I think that chart has got a long way to fall.
Yeah, I agree. So total assets pledged to decentralized finance protocols has halved in the space of about 3 days. Yeah, I mean, the whole DeFi universe has lost confidence. And Japan has passed this law that only stablecoins that are fully asset-backed and linked to the yen are allowed. And you would have to think, wouldn't you, a stablecoin couldn't possibly be stable if it weren't fully asset-backed, you would think.
But I mean, interesting to see what you think about this, Richard. But isn't having a stable coin that is regulated by the government rather against the point? I thought the whole thing was that this was going to be decentralized and beyond national governments.
I think stable coins were a use case looking for a reason. I mean, I've never understood stable coins. It seems pointless. Just buy the currency.
Yeah. So this is a really interesting chart from the market huddle last week. And essentially they had an options guy on. And he was pointing out that option expiry dates often coincide with big market turning points. You'll see Volmageddon, the taper tantrum in 2018, COVID crash, they all kind of bottomed close to option expiry dates. And that's interesting. That means that it's something we should watch for, timing big market turns. So just something to keep in mind.
Earnings growth appears to have stalled. I saw a graph today that showing that earnings expectations are still on the rise. I think anyone who expects earnings to increase is living in a parallel universe. Margins are falling as we predicted because costs are rising and companies can't pass all those increases on to the consumer.
Well, this is an interesting chart, Richard. This shows that share buybacks actually don't seem to affect the performance of the stock market. So the kind of mauve line is 12-month buybacks as a percentage of market cap. And that is the left-hand scale. And the blue line is the 12-month return of the S&P 500. And frankly, there ain't much of a relationship. So essentially, buybacks don't seem to affect the performance of the stock market.
Yeah.
In fact, when buybacks are low, the stock market does really well. When buybacks are high, it's done really badly. Okay, moving on to commodities. So commodity markets continue to grind higher in contrast to the equity market. So the Bloomberg Commodity Spot Index hit a new high last week, coincident with the equity bear market rally. Moving on to energy commodities. First of all, the outlook for energy. And we in the West are concerned with the energy transition and moving away from fossil fuels. But if you look at projected energy demand in the rest of the world, it's projected to be really strong in the coming decades. So, frankly, I find it difficult to envisage a net decline in fossil fuel consumption, no matter how bad that is for the planet, given the insatiable demand for energy coming from emerging markets. And moving on to the checklist, generally a very strong week. Brent was up 4.6%, WTI up 4.1%, Dutch natural gas futures up 1.1%. Coal fell. It's only up 133% year to date. Uranium bounced back, up 5%, up 20% year on year. And numbers relevant to the oil market now interesting. So we had inventory data for last week in the US, and actually there was a build. So total crude inventories grew by 3.7 million barrels, and total private inventories actually grew by almost 11 million barrels. So 7 million barrels were withdrawn from the SPR, and they added to private inventories, which grew very substantially last week. Now, the bull market in oil is built on the idea that there's an excess of demand over supply, which means we should be having consistent inventory drawdowns. So a build is potentially bad news, something to watch in coming weeks. Your total US crude production was flat at 11.9 million barrels, up only 100,000 barrels year to date. And we're now the best part of 6 months into the year. So we're really not seeing any supply response in the US. Very bullish for oil. Remember, US shale was meant to be the world's swing producer. Prices are going through the roof. The swing producer ain't reacting. The Baker Hughes rig count was at 474, unchanged on the week. So this is crude just grinding relentlessly higher. During recessions, you would expect oil demand to crash with economic activity. But the reality is, it doesn't really, because global growth continues. It's very rare to have a worldwide recession in which growth dips. And so during US recessions, world oil demand has actually continued to grow, something to bear in mind. And Goldman Sachs have increased their oil forecast, although they are expecting the oil price to peak quite soon, but above $140 a barrel. This is Russian oil production, and it was bouncing back, but then it's collapsed again, as have exports. And this is the SPR. The Biden administration is supporting US consumers by releasing stocks from the SPR, so supplying, making sure the price at the pump does not go stratospheric, but you can't continue doing that forever. The chart of the week was showing that gasoline supplied to US consumers was running well below pre-COVID levels. But then last week, we had a build in distillate inventories. Now, the only way those two are reconcilable is either we've had a big import that week and the numbers are volatile, depending on which tankers arrived in the US, or we are seeing demand destruction. So this is something to watch. And investors have been buying energy assets big time. Notably, they haven't been buying gold. And is the energy trade becoming crowded? Something to watch.
Interesting.
But bottom line is, if there is insufficient refining capacity, then gasoline and diesel prices are going to have to keep on rising until you get demand destruction and the two fall back into balance. Now, the inventory figures we've seen this week suggest we've had an inventory build, so perhaps we are getting back towards balance. But the weekly figures are volatile, and we'd need to see a regular pattern of that. And if that is the case, then you'd expect oil prices to cease climbing, and they've been climbing steadily this week. Dutch natural gas futures ticked up. Coal, the trend seems to be intact despite a bad week. Uranium bouncing back up. Richard.
Thanks, Keith. So a look at our industrial commodities weekly checklist. So not terribly exciting, I would say, for any of these industrial commodities. My sense is that they all have sort of come off their moves, and they're all marking time, whether they're waiting for another move up or not, and obviously remains to be seen. Copper was down fairly chunky 3.7%, and iron ore was up 2.8%, presumably again on the back of the Chinese releasing the lockdown conditions. So nickel seems to be up 2.5% on the week. It seems to be trending upwards gently, I would say, after the LME debacle of a few weeks ago, where they closed the markets and cancelled a large number of trades. I noticed the LME is being sued for around about $500 million in terms of losses for people who had their profitable trades cancelled. And as has been noted in various places, the biggest loser of those short positions that were cancelled would have been a Chinese citizen, and the LME is owned by a Chinese company. Draw your own conclusions. Tin had a good week, up 6.2%, big move for tin, but not very big move on the year net. Ferrovanadium down 4%, and zinc down 2.5%.
Yeah. Before we move on, Richard, I mean, what I find striking about all these commodities is copper. You know, because we hear a lot about how we have a big problem with future copper supply, and Goldman's have been talking about a super cycle in copper. And yet, copper has been very disappointing this year. It's crucial to the green transition, but it's down 2.3% year to date. It was down 3.7% last week.
Mm.
Yeah.
Well, I suppose we know that there's something big happening in the Chinese construction sector, which must have been a huge demand for copper. So maybe that we have a sort of a plus and a minus, and the big minus is outweighing the or balancing out the plus. It's very difficult to see that. I think China was one of the biggest consumers of copper for its building sector, and clearly it isn't at the moment.
Yeah, very good point. Well, Dr. Copper is currently forecasting negative things for the world economy.
Very true, Keith. Yeah. So a few charts: aluminium, cobalt, copper, chromium, iron ore, lithium, and Goldman calling for an end to the lithium bull market.
Yeah, so lithium's had a great run, but they are saying it's going to come right back down again next year. Interesting. Yeah,
one to watch. Don't be overexposed to lithium, I think, is the moral of that. Neodymium and nickel, as you can see, it is continuing the uptrend that it started back in late 2021. Tin, ferrovanadium.
We were mystified by the kind of bull market in ferrovanadium, and I'm still mystified. It shot up and it shot back down again.
Yeah, no particular reason. I'm sure there was a reason. Don't know what it was. So moving on to precious metals, pretty much a ho-hum week for them. Gold down 1%, unchanged on the year, effectively. Silver down nearly 3% and down on the year. Platinum unchanged effectively on the year, but down 4.5% this week. Rhodium 5.6% down, and palladium 5.3% down. And one wonders if those platinum, palladium, and rhodium figures are as a consequence of reduced car production.
Yeah.
So that's chart of gold.
Very disappointing.
Yeah.
It could, well, the thing is, I fully expect gold to have a very good decade, because I think, fiat currencies were just printing too much money. All the contradictions of money printing, excess debt, and inflation may start to reveal themselves this decade. And the thing I'd say about this prediction that the gold to S&P ratio is going to revert to its previous average, that could well be true, but that could be achieved by gold going nowhere and the S&P totally cratering.
There are two ways of that, aren't there? How that can happen. Yeah. Silver chart, platinum, and rhodium, and palladium.
Okay, thank you, Richard. Okay, on to rates. And despite the sell-off in equity markets, there was no safe haven buying of bonds. So in the UK, the whole yield curve shifted up, and actually quite substantial amounts. So the UK 2-year rose by 17 basis points to 1.84%. At the long end, we had smaller rises. So the 50-year rose by 4 basis points, but again, new highs. But the big action was in the Eurozone periphery. So we've had a sell-off. So the Greek 10-year rose by 44 basis points on the week to 4.1%. And remember that most Greek debt is actually held by Eurozone institutions, so it's not really that exposed to market rates. Italy, however, is. And its 10-year rose by 47 basis points on the week to 3.7%. This is the Italian 10-year bond yield, rising quickly. Italy is one of the most heavily indebted nations in the world. This is bad. Essentially, the average duration of Italian bonds is 7 years. And if we look at the yield on Italian 7-year bonds, in August last year, so i.e. within the last year, only 10 months ago, the Italian 7-year was yielding 0.15%. And so at that point, Italy could refinance its maturing debts and borrow at 0.15%. Now, if it wants to replicate its current maturity profile and buy 7-year bonds, sell 7-year bonds, it would have to pay best part of 3.2%. So this, if continued, will cause a solvency crisis in Italy quite quickly. Richard.
Okay, so I just picked these three article headlines from the FT this morning, and I was just struck by so they're all quite close to each other within a couple of pages. And so we have President, that's the President of the ECB, top left. President takes markets by surprise with plans to quicken the pace of rate rises. The ECB surprised markets when it signaled it was likely to raise rates by 0.5 percentage point in September, in addition to a planned 1/4 point rise in July. And this is like living in an Alice in Wonderland world, where we have inflation somewhere, depending on what figures you believe, between 8 and 15% in Europe, and the ECB is sort of dancing around with these extraordinarily out of kilter interest rate rises. Then we have fears of demand void in corporate bond trade as ECB ends stimulus, and Lagarde vows to prevent repeat of debt crisis, but skips details. And the reason she skips the details is because there is no way that they can end the repeat of the debt crisis other than by not raising interest rates and probably doing QE as well. And I think the ECB is totally in a corner, and I don't think it can get out of it.
No, absolutely, Richard. And we have done a special podcast on the return of the Eurozone crisis, we did a few months ago now, and we've done various special segments on the ECB is trapped, but it is. I mean, the trouble is that it's now saying it's going to raise rates, but just the threat of stopping bond purchases, you're seeing a spike in Italian bond yields. And essentially, the market needs to know that there's a backstop, that Italy will not be allowed to go bust. And as long as there is uncertainty about that, nobody will buy Italian debt and bond yield will continue to rise. So I am expecting that they will have to announce what they're going to do to suppress the spreads between the periphery and the core by the 1st of July. This will accelerate over the next couple of weeks.
I'm sure you're right, Keith. I think the problem they have is that they're continuing to try to use we can talk the market where we wish it to go, and we don't have to actually do anything. And I think they are in severe danger of losing their credibility. And the market, I think, is starting to understand the ECB has nowhere to go.
Yeah. So I don't know what they're going to do, actually, because they need to suppress Italian yields, but written into the articles of the Eurozone explicitly ruled out fiscal transfers. Now, they've been doing monetary transfers, but they are pretty much the same thing. So they're either going to have to allow the ECB to buy large amounts of Italian debt, which essentially is a monetary transfer, or they're going to, I don't see an alternative. The alternative is if they allow Italian bonds to be priced at market rate, then they go through the roof and Italy goes bankrupt.
Exactly. And we go back to where we were when Mario Draghi said they'll do anything it takes.
Yeah.
The only difference being there is nothing they can do on this occasion. I don't see.
Yeah. So they're in a bind. Yeah. Essentially, it was okay for Mario Draghi to say, we'll do whatever it takes. But whatever it takes meant printing loads of money. And now if you take that option off the table, they don't have any options left.
Other than a stonking recession.
Yeah.
And European.
So this is, to my mind, the most important development this week. I think the Eurozone crisis is coming back, and it's coming back fast. And so the implications are further falls in the euro, an accelerating rises in the yield of bonds in the periphery until we know what's going to happen, how Europe is going to prevent a solvency crisis in Italy. And I don't know what they're going to do. But until we know, why would you buy Italian bonds? People will flee.
Yeah.
So if Italy falls out of the Eurozone, because that's what would happen, it would be forced to default on its Eurozone debts and repay them in lira. You would have an almighty financial crisis. Most of the banks in Europe would go bust, I reckon.
Yeah. The consequence would be vast sums of money printing, because that's the only way you can stop the banks going bust. And it would stop the banks going bust, but clearly it would cause a massive currency problem.
Yeah. Yeah, the only thing they could do. So Italy, obviously, it would fall out of the Eurozone and repay in lira, which would print. And in the Eurozone, the banks would have to be recapitalized with printed money.
Yeah. So if you've got any euro assets, now might be a good time to sell them.
Yeah. The UK is safe haven.
It's all relative, Keith.
Yeah. I just don't understand why gold's not going through the roof.
I think it will do. I think it's just a question of time, and it will do.
So this is Greece.
In fact, I think now is a good opportunity to buy it.
This is the UK 10-year, actually climbing steadily.
I mean, unfortunately, the same applies to the UK as applies to many of the European countries.
Yeah, at least we have our own currency, which we can print like mad.
Yes.
Now, this is the 2050 gilt. It's not had a good week. We'll go into this a bit more later. US 10-year climbing back above 3%. And finally, concluding comments. Well, the big thing is the Eurozone crisis is returning. Bonds and equities resumed their sell-off. Really, there are very few safe havens for investors, although oil and oil stocks had a good week. But despite all the headwinds, the US and European economies are still growing, and so far they've been resilient, although growth appears to be slowing. Okay, Richard, what have you been up to this week?
So my portfolio, very quiet week, small down 0.2%, change for year now 9.1%, relative performance of 11.7%. I sat on my hands yet again, no purchases, no sales. As a reminder, I'm in commodities with quite a high weighting of precious metals. And I am trying to do very little. I just came across this chart, Japanese budget deficits over the last 45 years and spending versus tax income. And notice that T0 is around about the time the world effectively went off the gold standard.
Yeah.
And obviously, at some point, this is unsustainable. And there we are. Gold versus government bonds. So since 2014, there's been a tight correlation.
Mm.
And now that correlation is broken down.
Oh, that's really interesting.
So as interest rates rise, gold is not falling.
Yeah.
And that has been the correlation over the last 7 or 8 years. And it's a change of behavior, I would say.
Mm.
And I think, and I may be wrong, obviously, but I think that there is a growing understanding that the central banks are between a rock and a hard place, and they can't solve this problem. And that if you want to protect your wealth, you have to go into real assets, and gold is one of those real assets. You don't want to be in bonds, you don't want to be in shares, you don't want to be in any financial asset.
Now, actually, on that point, Richard, coming out this week, I am going to do a special on Turkey and how Turkish citizens have tried to protect themselves from very high rates of inflation in Turkey, and what the performance of Turkish assets have been, both in nominal and in real terms. And I think that's really interesting as a real world experiment in how to protect yourself against inflation. And spoiler alert, actually, they've been buying crypto.
Have they? That's very interesting, Keith, and also an up-to-date example. So I look forward to seeing that. So that's me. How about you, Keith? How was your week?
Thank you, Richard. I had an okay week. I was up 0.25%, which was much better than the all share, and I'm doing well on the year and very well compared to the all share. Now, I continued to sell the entire portfolio down, and I didn't buy anything. So at the start of the week, I was down to 20% equities, almost 80% cash. Now, as our Discord viewers will know, oil equities had a great week. So, it's clear that I have sold prematurely, but I think you have to sell at some stage, and I'm sticking with the strategy. So these are my equity allocations. still mainly gold, and I've concentrated in the most liquid. So I've got a large shareholding in Shell, and actually Shell is now the majority of my oil equities. Gold Plat has been doing well, and it's a gold producer, and I am holding on to it. Okay, so my rather impetuous purchase of the 2071 gilt is not going well. So this week, it actually dipped below 80. And earlier in the week, Richard and I had dinner with an old friend of ours who is a fund manager, and he was very skeptical of my gilt trade. And his argument was that I was playing a cyclical game, assuming that this cycle would be like the last cycle, but he thought there'd been a phase transition, and we are now in structurally higher inflation, and that bond yields had a lot higher to rise. Now, so I've gone back and had a look at the performance of bonds in the 1970s, when again there was this very high inflation, and in particular how bonds did in 1974, when you remember that oil prices rose and stayed high. So inflation didn't come down that much. So this is inflation in the 1970s. You see in 1974, during the recession, it was over 12%. And this is the Fed funds rate during the 1970s. And you see during the recession, the Fed actually raised rates. So it started by cutting them, and then it raised them in the depths of the recession. And that contributed to a huge sell-off in equities. Now, one thing that I really notice about that period is that M2, the money supply, continued to grow. So M2 is the black line, and the red line is inflation. You'll see, even in the depths of the recession, M2 was growing at 6%. So I think it's going to be crucial to watch how the money supply reacts this time. And if the money supply continues strong during this period, then actually my trade buying bonds could be the incorrect one. But we know that we're going to have QT, and I'm expecting the money supply to contract. So this is the US 10-year, sorry, this is the US 1 year over that period. And actually, it fell quite sharply from the peak, but you had to time the peak correctly. And it wasn't, so it fell from 10% to 6%. The 10-year really didn't fall much at all. And so you again had to time the peak correctly, and then the reward really wasn't very much. So message from 1970s is during periods of high inflation, then bond yields don't come down that much. And my trade, which is a cyclical trade based on the performance of bonds during the last few cycles since 1981, when Volcker got inflation under control. If inflation is now out of control, then my trade's the wrong one. It won't work. And that is something I am going to be watching very carefully. So, in summary, the 2071 gilt dipped below my next target of £80 this week, and I haven't touched it. Actually, I'm not going to buy more. I bought 2% of the portfolio in it, and I was going to add to it. Actually, I'm not. I realized this could go a lot lower. So I'm just going to keep on watching it. But my base case is still, we go into recession, money supply collapses, that inflation comes down, and long bonds are the place to be as interest rates are cut in response to recession and falling inflation. But if inflation remains persistent and interest rates don't come down, then frankly, that is a bad trade and it could cost me a lot of money. So jury's out, watching.
Interesting, Keith.
So finally, just on to a few of the stocks that we've covered on the podcast. This is Rambler. Rambler had a good week. Its latest production numbers were out and they were reassuring. So hopefully the big turnaround situation at Rambler is building some momentum. Goldplat. Now, Goldplat actually got some coverage this week. I think WH Ireland wrote a long piece on Goldplat, giving it a good price target, which I think is double where it is now. So are institutions finally recognizing the potential there? Somebody's been buying it. Very good. I've got a big position in Goldplat and I'm sticking with it. But I'm not buying more because frankly, it's not very liquid. If the liquidity improves, I might buy more.
Just looking at the chart of Goldplat, Keith, and it has actually broken out of its range.
Good. I'll take your word for that, Richard. And this is PetroTal, which we did a share talk on. And I want to talk about this because this shows the problem of investing in something when you no longer have complete confidence in the trade. So I did a podcast on it. I bought it back here in March and the share price drifted off. And, regular viewers will know I've been selling down the portfolio because I think equities are going to have a bad run. And although I'm expecting the oil price to rise, I think oil equities will eventually follow equities down rather than the oil price up. And so when PetroTal was drifting off, I decided to cut the position. And then the moment I'd done that, its share price promptly rose 50%. There you go. If you have a fundamental view, you need to stick with it because you don't know when the market's going to wake up to it. And the problem with having a position in a company where you're not totally committed to it is that you can get knocked out of the trade, which is exactly what happened to me. Okay, that's it. Thank you all for watching. It's been a busy week in the markets and there's a lot going on. And frankly, I'm really concerned about the Eurozone. So that will happen live over the next few weeks and is something we'll be watching very closely. But in the meantime, please can you press like and subscribe to the channel, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.